Open a ZERODHA account. Chapter 9. The Trading Terminal. 9.1 Overview. When a market participant wants to transact in the market, he can do so by opting one of the options. Call the stockbroker and trade, usually called call and trade. Use a web browser to access the markets. Use the trading software called the Trading Terminal. Each of the above method is a gateway to the exchanges. The gateway allows you to do multiple things such as transacting in shares, tracking your profit and loss, tracking market movements, following news, managing your funds, viewing stock charts, accessing trading tools, etc. The purpose of this chapter is to familiarize you with the Trading Terminal (TT) and its interface. A trading terminal is software which can be downloaded from your broker's website and is installed on your computer. The trading terminal is quite a user-friendly interface, as most of its functionalities are menu-driven. To access the trading terminal, you need to have a trading account with your broker. A good TT offers you numerous useful features. We will start by understanding a few basic features. To keep this chapter as practical as possible, let us set 2 basic tasks to using the TT. Buy 1 share of ITC and track the price of Infosys. While we achieve the above 2 tasks, we will also learn about all the relevant concepts. For the purpose of this chapter, we will be using Zeroda's trading terminal called the Zeroda Trader CT. 9.2 The login process. The trading terminal is quite sensitive as it contains all your trading account information. In order to ensure adequate security, brokers usually follow a stringent login process. The process involves entering your password, selecting an image that you have pre-assigned, and answering 2 secret questions, the answers to which only you know. The snapshot below shows this process. 9.3 The Market Watch. Once you log into the software, you will have to populate the Market Watch with the stocks you are interested. Think about the Market Watch as a blank slate. Once the stock is loaded on the Market Watch, you can easily transact and query information about it. A blank Market Watch looks like this. This is also the screen that you see once you log in. Keeping the first task in mind, we will load ITC Limited onto the Market Watch. To do this, we simply have to select the exchange, market segment, and the stock. These options are easily accessible in the drop-down menu. You hit enter when the stock you want is identified. The stock now sits in the Market Watch column titled Symbol. The next step is to add all the relevant columns next to the symbol so that we can get all the desired information related to the stock. Some basic information that is needed at this point would be the last traded price of the stock, LTP. This gives us a sense of how much the stock is trading at the very moment. Previous day close. At what price did the stock close the previous day? Percentage change. This indicates the percentage points the LTP is varying with respect to the previous day close. OHLC, open, high, low and close, gives us a sense of the range within which the stock is trading during the day. Volumes gives a sense on how many shares are being traded at a particular point of time. To add these columns, one has to right-click, keeping the cursor near the column space, and select on Reposition Column option. By clicking on the button Reposition Columns, one would be directed to a list of variables that can be added to the column settings in the Market Watch. We will have to select the column variables we are interested in. Once these variables are selected, the Market Watch will now look like this. As you can see, the last traded price of ITC is 333 rupees and 55 paise. It is trading minus 0.74% lower than the previous day close, which is 336 rupees and 5 paise. The open for the day was at 336 rupees and 45 paise. The highest price and the lowest price at which the stock traded for the day was 336 rupees and 80 paise, and 332 rupees and 75 paise respectively. The volume for the day is close to 3.9 million shares. 9.4 Buying a stock through the trading terminal. Our goal is to buy 1 share of ITC. We now have ITC in our trading terminal, and we are convinced that buying ITC at 332 rupees, which is roughly 1 rupee and 55 paise lesser than the last traded price, is a great idea. The first step for this process would be to invoke what is called a buy order form. There are 2 ways to invoke a buy order form. Highlight the stock you wish to transact in by clicking the mouse and press the F1 key. Right-click on the stock you wish to transact in and click on Buy Order Entry. Let us proceed by pressing F1. When the buy order form is invoked, the following order form will appear on your market watch. The order form is pre-populated with some information like the price and quantity. We need to modify this as per our requirement. Let us begin by the first drop-down option on the top. By default, the exchange specified would be NSE. If you wish to transact in BSE, you can do so by selecting BSE in the drop-down menu. The next entry is the order type. By clicking on the drop-down menu, you will see the following 4 options: Limit, Market, SL Market. Let us understand what these options actually mean. You can opt for a limit order when you are very particular about the price you want to pay for a stock. In our case, the last traded price of ITC is 333 rupees and 55 paise, but say we want to limit our buy price to 332 rupees. In such a situation where we are particular about the price we want to transact in, we can opt for a limit order price. If the price does not fall to 332 rupees, then you will not get the shares. This is one of the drawbacks of a limit order. You can also opt for a market order when you intend to buy at market available prices instead of a very specific price that you have in mind. So if you were to place a market order, as long as there are sellers available, your order will go through and ITC will be bought in the vicinity of 333 rupees and 55 paise. Suppose the price goes up to 335 rupees coinciding with your market order placement. Then you will get ITC at 335 rupees. This means when you place a market order, you will never be sure of the price at which you would transact. And this could be quite a dangerous situation if you are an active trader. A stop-loss order protects you from an adverse movement in the market after initiating a position. Suppose you buy ITC at 332 rupees with an expectation that ITC will hit 350 rupees in the near future. But instead, what if the price of ITC starts going down? We can protect ourselves firstly by defining what would be the worst possible loss you are willing to take. For instance, in the example, let us assume you don't want to take a loss beyond 325 rupees. This means you have gone long on ITC at 332 rupees and the maximum loss you are willing to take on this trade is 7 rupees 325. If the stock price drops down to 325 rupees, the stop-loss order gets active and hits the exchange and you will be out of the loss-making position. As long as the price is above 325, the stop-loss order will be dormant. A stop-loss order is a passive order. In order to activate it, we need to enter a trigger price. A trigger price, usually above the stop-loss price, acts as a price threshold, and only after crossing this price the stop-loss order transitions from a passive order to an active order. Going with the above example, We are long at 332 rupees. In case the trade goes bad, we would want to get rid of the position at 325 rupees. Therefore, 325 is the stop loss price. The trigger price is specified so that the stop loss order would transition from passive to active order. The trigger price has to be higher than the stop loss price. We can set this to 326 rupees and 75 paise. If the price drops to 326 rupees and 75 paise from 332, the stop loss order gets active. Going back to the main buy order entry form. Once the order type is selected, we now move directly to the quantity. Remember, the task is to buy 1 share of ITC. Hence we enter 1 in the quantity box. We ignore the trigger price and disclosed quantity for now. The next thing to select would be the product type. Select CNC for delivery trades. Meaning if your intention is to buy and hold the shares for multiple days, months, years, then you need to ensure the shares reside in your Demat account. Selecting CNC is your way of communicating this to your broker. Select NRML or MIS if you want to trade intraday. MIS is a margin product. We will understand more on this when we take up the module on derivatives. Once these details are filled in your order form, the order is good to hit the markets. The order gets transmitted to the exchange as soon as you press the submit button on the order form. The unique order ticket number is generated against your order. Once the order is sent to the exchange, it will not get executed unless the price hits 332 rupees. As soon as the price drops to 332 rupees, and assuming there are sellers willing to sell 1 shares, your order gets through and is eventually executed. As soon as your order is executed, you will own 1 shares of ITC. 9.5 The order book and trade book. The order book and trade book are 2 online registers within Trading Terminal. The order book keeps track of all the orders that you have sent to the exchange, and the trade book tracks all the trades that you have transacted during the day. The order book has all the details regarding your order. You can invoke an order book by navigating order and trades greater than order book in the Trading Terminal. Alternatively, you can press the F3 key to invoke the same. The order book provides the details of the orders you have placed. You should access the order book to double-check the order details, quantity, price, order type, product type. Modify the orders. For example, if you want to modify the buy order from 332 to 333, you can do so from the order book. Check status. After you have placed the order, you can check the status of the same. The status would state open if the order is completed partially. It would state completed if the order has been completed. And it would state rejected if your order has been rejected. You can also see the details of the rejection in the order book. Here is the snapshot of the order book. As you can see, the order book is split into 2 sections. The first section is for open orders. It lists down all the orders that are placed and not yet executed. If you notice, there is an open order to buy 1 share of ITC at 332 rupees. The second section of the order book contains details of the completed orders. If there are no completed orders, this part will be blank. Right below the order book, you have options to cancel or modify your order. By clicking Modify, the order form will be invoked and you can make the desired changes to the order. Once the order has been processed and the trade has been executed, the trade details will be available in the trade book. To invoke a trade book, go to Orders and Trades and select Trade Book from the menu, or simply press F8 key. Here is a snapshot of the trade book. The trade book confirms that the user DA1171 executed an order to buy 1 share of ITC at 334.15. Through his broker 13906, this is zeroed as ID. Also notice a unique exchange order number is generated for the trade. So with this, our first task is complete. You now officially own 1 share of ITC. This share will reside in our Daymod account till you decide to sell it. The next task is to track the price of Infosys. The first step would be to add Infosys to the Market Watch. We can do this by searching for Infosys in the search box. The trading symbol for Infosys is INFI. Once we select INFI, we press Enter to add it to the Market Watch. We can now track some live information about Infosys. The last trade price is 3,295 rupees. The stock is up 1.68% from its previous day's close of 3,240 rupees and 50 paise. Infosys opened the day at 3,245 rupees and 85 paise, made a low of 3,245 rupees and 10 paise and a high of 3,306 rupees and 85 paise. The volumes were 0.78 million shares. Please note, while the open price will be fixed at 3,245 rupees and 85 paise, the high and low prices changes and when the price of Infosys changes. For example, if Infosys moves from 3,295 rupees to 3,310 rupees, then the high price will reflect 3,310 rupees as the new high. Notice that the LTP of Infosys is highlighted in blue and ITC in red. If the current LTP is more than the previous LTP, the sell is highlighted in blue, else in red. Have a look at the snapshot below. The price of Infosys dropped from 3,295.0 to 3,292.3. And hence the color changed to red from blue. Besides the basic information about the LTP, OHLC, and volume, we can also dig a bit deeper to understand the real-time market participation. To see this, we need to invoke what is called a market depth window, also referred to as the snap quote window. Invoking this is simple. Highlight the symbol and press F6 and you will see a market depth window as shown below. As you can see, there is a lot of information in the snap quote window. I specifically want to draw your attention to the numbers in blue and red called the bid and ask prices. 9.6 the bid and ask price. If you want to buy a share, you obviously need to buy it from a seller. The seller will sell the shares at a price that he thinks is fair enough. The price that the sellers ask you is called the ask price. The ask price is highlighted in red. Let us analyze this in a bit more detail. SL no ask price, ask quantity, number of sellers 01 3294.8022, 02 3294.8542, 03 3295.0082, 04 3296.20251, 05 3296.2551. By default, the snap quote window displays the top 5 bid and asks prices. In the table above we have the top 5 ask prices. The first ask price is 3,294 rupees and 80 paise. At this particular moment, this is the best price to buy Infosys, and there are only 2 shares available at this price, being offered by 2 different sellers. Both of them are selling 1 share each. The next best price is 3,294 rupees and 85 paise. At this price there are 4 shares available being offered by 2 different sellers. The third best price is 3,295 rupees at which 8 shares are available. And this price is offered by 2 sellers. So on and so forth. As you notice, the higher the ask price, the lower is the priority. For example, at 5th position is an ask price of 3,296 rupees and 25 paise for 5 shares. This is because the stock exchanges give priority to sellers willing to sell their shares at the least possible price. Notice even if you want to buy 10 shares at 3,294 rupees and 80 paise, you can only buy 2 shares because there are only 2 sellers at 3,294 rupees and 80 paise. However, if you are not particular about the price, aka limit price, you can place a market order. When you place a market order at this stage, this is what happens. 2 shares are bought at 3,294 rupees and 80 paise. 4 shares are bought at 3,294 rupees and 85 paise. 4 shares are bought at 3,295 rupees. The 10 shares will be bought at 3 different prices. Also in the process, the LTP of Infosys will jump to 3,295 rupees from 3,294 rupees and 80 paise. If you want to sell a share, you obviously need to sell it to a buyer willing to buy it from you. The buyer will buy the shares at a price that he thinks is fair enough. The price that the buyer demands is called the bid price. The bid price is highlighted in blue. Let us analyze this part in a bit more detail. SL no bid price, bid quantity, number of buyers 01 3,294.7510.5 02 3,294.2061 03 3,294.1511 04 3,293.8561 05 3,293.75125.1. Again, by default, the snap quote window displays the top 5 bid prices. Notice the best price at which you can sell shares is at 3,294 rupees and 75 paise. And at this price you can only sell 10 shares as there are only 5 buyers willing to buy from you. If you were to sell 20 Infosys shares at market price, the following would be the execution pattern. 10 shares sold at 3,294 rupees and 75 paise. 6 shares sold at 3,294 rupees and 20 paise. 1 share sold at 3,294 rupees and 15 paise. 3 shares sold at 3,293 rupees and 85 paise. So in essence, the bid and ask prices gives you information about the top 5 prices at which the buyers and sellers are stacked up. It is extremely important for you to understand how the buyers and sellers are placing their trades, especially if you are an intraday trader. 9.7 Conclusion. The trading terminal is your gateway to markets. Trading terminal has many features that are useful to traders. We will explore these features as we progress through the various learning modules. For now, you should be in a position to understand how to set up a market watch, transact, buy and sell in stocks, View the order and trade book, and understand the market depth window. Key takeaways from this chapter. A trading terminal is your gateway to markets. You must know the operations of a trading terminal if you aspire to become an active trader. You can load the stock you are interested in on the Market Watch to track all the relevant information. Some of the basic information on Market Watch is LTP, percent change, OHLC and volumes. To buy a stock, you need to invoke a buy order form by pressing F1. Likewise, to sell a stock, you need to invoke a sell order form by pressing F2 key. You choose a limit order type when you are keen on transacting at a particular price. Else you can opt for a market order. You choose CNC as product type if you want to buy and hold the stock across multiple days. If you want to trade intraday, you choose NRML or MIS. An order book lets you track orders that are both open and completed. You can modify the open orders by clicking on the Modify button at the bottom of the order book. Once the order is completed, you can view the trade details in the trade book. In case of a market order, then you can view the exact trade price by accessing the trade book. You can press the F6 key to invoke the market depth or snap quote window. The Market Watch enables you to see bid and ask prices. The bid and ask prices refers to the price at which you can transact. By default, the top 5 bid and ask prices are displayed in the market depth window at all times. Open a ZERODHA account. Chapter 10. Clearing and Settlement Process. Hindi. 10.1 Overview. While the topic on clearing and settlement is quite theoretical, it is important to understand the mechanics behind it. As a trader or an investor, you need not actually worry about how the trades are cleared and settled, as there are professional intermediaries to carry out this function seamlessly for you. However, the lack of understanding of the clearing and settlement process could leave a void, and would not give a sense of completeness to the learning process. Hence, for this reason, we will explore what happens behind the scene from the time you buy a stock to the time it hits your Demat account. We will keep this very practical with a clear emphasis on what you as a market participant should really know. 10.2 What happens when you buy a stock? Day 1 The trade, T-Day. Monday. Assume on the 23rd of June 2014, Monday, you buy 100 shares of Reliance Industries at 1,000 rupees per share. The total buy value is 100,000 rupees per 100*1000. The day you make the transaction is referred to as the trade date, represented as T-Day. By the end of trade day, your broker will debit 100,000 rupees per and the applicable charges towards your purchase. Assuming the trade is executed through Zerodha, the applicable charges would be as follows. SL No chargeable item. Applicable charges amount 01 Brokerage 0.1% or 20 rupees per, whichever is lower. 20. 02 Security transaction charges 0.1% of the turnover. 100. 03 Transaction charges 0.00325% of the turnover 3.25. 04 Service tax 12% of brokerage plus transaction charges 2.79. 05 Education cess 2% of service tax 0.0558. 06 Higher Education cess 1% of service tax 0.0279. 07 SEBI charges 20 rupees per crore of transaction 0.2. Total 126.32. So in amount of 100,000 rupees per plus 126 rupees and 32 paise per, which includes all the applicable charges, totaling 100,126 rupees and 32 paise per will be debited from your trading account the day you make the transaction. Do remember, the money goes out of your account but the stock has not come into your Demat account yet. Also, on the same day the broker generates a contract note and sends you a copy of the same. A contract note is like a bill generated detailing every transaction you're made. This is an important document which is worth saving for future reference. A contract note typically shows a breakup of all transactions done during the day along with the trade reference number. It also shows the breakup of charges charged by the broker. Day 2 Trade Day plus 1 T plus Day. Tuesday. The day after you made the transaction is called the T plus 1 day. On T plus 1 day you can sell the stock that you purchased the previous day if you do so. You are basically doing a quick trade called buy today, sell tomorrow BTST, or acquire today, sell tomorrow ATST. Remember, the stock is not in your Demat account yet. Hence, there is a risk involved, and you could be in trouble for selling a stock that you don't really own. This doesn't mean every time you do a BTST trade you end up in trouble. But it does once in a way, especially when you trade B group and illiquid stocks. The reason why this happens is a little convoluted, and we deliberately will not touch this topic now. If you are starting fresh in the markets, I would suggest you do not do BTST trades unless you understand the risk involved. From your perspective, nothing happens on T plus 1 day. However, in the background, the money required to purchase the shares is collected by the exchange, along with the exchange transaction charges and security transaction tax. Day 3 Trade Day plus 2 T plus 2 day. Wednesday. On day 3 of the T plus 2 day, around 11 a.m. shares are debited from the person who sold you the shares and credited to the brokerage with whom you are trading, who will in turn credit it to your Demat account by end of day. Similarly, money which was debited from you is credited to the person who sold the shares. The shares will now start reflecting in the Demat account, indicating that you own 100 shares of Reliance. So for all practical purposes, if you buy a share on day T day, you can expect to receive the shares in your Demat account only by end of T plus 2 day. The shares are available for transaction on T plus 3 day. 10.3 What happens when you sell a stock? The day you sell the stocks is again called the trade day, represented as T day. The moment you sell the stock from your Demat account, the stock gets blocked. Before the T plus 2 day, the blocked shares are given to the exchange. On T plus 2 day, you would receive the funds from the sale, which will be credited to your trading account after deduction of all applicable charges. Key takeaways from this chapter. The day you make a transaction, it is called the trade date, represented as T day. The broker is required to issue you a contract note for all the transactions carried out by end of T-day. When you buy a share, the same will be reflected in your Daymod account by end of T+2 day. All equity, stock settlements in India happen on a T+2 basis. When you sell shares, the shares are blocked immediately and the sale proceeds credited again on T+2 day. 190 responses to clearing and settlement process. Open a Zerodha account. Chapter 11. 5 Corporate Actions and its Impact on Stock Prices. Hindi. 11.1 Overview. Corporate actions are initiatives taken up by a corporate entity that bring in a change to its stock. There are many types of corporate actions that an entity can choose to initiate. A good understanding of these corporate actions gives a clear picture of the company's financial health, and also to determine whether to buy or sell a particular stock. In this chapter, we will be looking into the 4 most important corporate actions and their impact on stock prices. A corporate action is initiated by the board of directors and approved by the company's shareholders. 11.2 Dividends. Dividends are paid by the company to its shareholders. Dividends are paid to distribute the profits made by the company during the year. Dividends are paid on a per-share basis. For example, during the financial year 2012-13, Infosys had declared a dividend of 42 rupees per share. The dividend paid is also expressed as a percentage of the face value. In the above case, the face value of Infosys was 5 rupees per and the dividend paid was 42 rupees per, hence the dividend payout is said to be 840%, 42/5. It is not mandatory to pay out the dividends every year. If the company feels that instead of paying dividends to shareholders they are better off utilizing the same cash to fund new project for a better future, then can do so. Besides, the dividends need not be paid from the profits alone. If the company has made a loss during the year but it does hold a healthy cash reserve, then the company can still pay dividends from its cash reserves. Sometimes distributing the dividends may be the best way forward for the company. When the growth opportunities for the company have exhausted and the company holds excess cash, it would make sense for the company to reward its shareholders, thereby repaying the trust the shareholders hold in the company. The decision to pay dividend is taken in the annual general meeting, AGM, during which the directors of the company meet. The dividends are not paid right after the announcement. This is because the shares are traded throughout the year and it would be difficult to identify who gets the dividend and who doesn't. The following timeline would help you understand the dividend cycle. Dividend declaration date. This is the date on which the AGM takes place and the company's board approves the dividend issue. Record date. This is the date on which the company decides to review the shareholders' register to list down all the eligible shareholders for the dividend. Usually the time difference between the dividend declaration date and record date is at least 30 days. Ex-date, ex-dividend date. The ex-dividend date is normally set 2 business days before the record date. Only shareholders who own the shares before the ex-dividend date are entitled to the dividend. This is because in India the normal settlement is on T+2 basis. So for all practical purposes, if you want to be entitled for dividend, you need to ensure you buy the shares before the ex-dividend date. Dividend payout date. This is the day on which the dividends are paid out to shareholders listed in the register of the company. Cum dividend. The shares are said to be cum dividend till the ex-dividend date, when the stock goes ex-dividend. Usually the stock drops to the extent of dividends paid. For example, if ITC, trading at Rs. 335, has declared a dividend of 5 rupees. On X-date, the stock price will drop to the extent of dividend paid. And as in this case, the price of ITC will drop down to 330 rupees. The reason for this price drop is because the amount paid out no longer belongs to the company. Dividends can be paid anytime during the financial year. If it's paid during the financial year, it is called the interim dividend. If the dividend is paid at the end of the financial year, it is called the final dividend. 11.3 Bonus issue. A bonus issue is a stock dividend allotted by the company to reward the shareholders. The bonus shares are issued out of the reserves of the company. These are free shares that the shareholders receive against shares that they currently hold. These allotments typically come in a fixed ratio such as 1:1, 2:1, 3:1, etc. If the ratio is 2:1 ratio, the existing shareholders get 2 additional shares for every 1 share they hold at no additional cost. So if a shareholder owns 100 shares, then he will be issued an additional 200 shares. So his total holding will become 300 shares. When the bonus shares are issued, the number of shares the shareholder holds will increase, but the overall value of investment will remain the same. To illustrate this, let us assume a bonus issue on different ratios 1:1, 3:1 and 5:1. Bonus issue no of shares held before bonus share price before bonus issue value of investment number of shares held after bonus share price after bonus issue value of investment. 1 to 1,175 7,500 237.5 7,500 3 to 1 30,550 16,500 120,000 137.5 16,500 5 to 1 2015 30,000 12,000 2.5 30,000. Similar to the dividend issue, there is a bonus announcement date, ex-bonus date, and record date. Companies issue bonus shares to encourage retail participation, especially when the price per share of a company is very high and it becomes tough for new investors to buy shares. By issuing bonus shares, the number of outstanding shares increases, but the value of each share reduces as shown in the example above. 11.4 Stock split. The word stock split for the first time sounds weird, but this happens on a regular basis in the markets. What this means is quite obvious: the stocks that you hold actually are split. When a stock split is declared by the company, the number of shares held increases, but the investment value, market capitalization, remains the same, similar to bonus issue. The stock is split with reference to the face value. Suppose the stock's face value is 10 rupees. And there is a 1-to-1 stock split, then the face value will change to 5 rupees. If you owned 1 share before split, you would now own 2 shares after the split. We will illustrate this with an example. Split ratio: old FV now of shares you own before split, share price before split, investment value. Before split, new FV now of shares you own after split, share price after the split, investment value. After split. 1-to-1 10,100,000 990,000 5,200,000 450 90,000 1-to-5 10,100,000 990,000 2,500,000 180 90,000. Similar to bonus issue. Stock split is usually to encourage more retail participation by reducing the value per share. 11.5 Rights issue. The idea behind a rights issue is to raise fresh capital. However, instead of going public, the company approaches their existing shareholders. Think about the rights issue as a second IPO, but for a select group of people, existing shareholders. The rights issue could be an indication of a promising new development in the company. The shareholders can subscribe to the rights issue in the proportion of their shareholding. For example, 1-to-4 rights issue means for every 4 shares a shareholder owns, he can subscribe to 1 additional share. Needless to say, the new shares under the rights issue will be issued at a lower price than what prevails in the markets. However, a word of caution: the investor should not be swayed by the discount offered by the company, but they should look beyond that. Rights issue is different from bonus issue, as one is paying money to acquire shares. Hence, the shareholder should subscribe only if he or she is completely convinced about the future of the company. Also, if the market price is below the subscription price, right issue price, it is obviously cheaper to buy it from the open market. 11.6 Buyback of shares. A buyback can be seen as a method for a company to invest in itself by buying shares from other investors in the market. Buybacks reduce the number of shares outstanding in the market. However, buyback of shares is an important method of corporate restructuring. There could be many reasons why corporate choose to buy back shares. Improve the profitability on a per-share basis, to consolidate their stake in the company, to prevent other companies from taking over, to show the confidence of the promoters about their company, to support the share price from declining in the markets. When a company announces a buyback, it signals the company's confidence about itself. Hence, this is usually a positive for the share price. Key takeaways from this chapter. Corporate actions has an impact on stock prices. Dividends are means of rewarding the shareholders. Dividend is announced as a percentage of face value. If you aspire to get the dividend, you need to own the stock before the ex-dividend date. A bonus issue is a form of stock dividend. This is the company's way of rewarding the shareholders with additional shares. A stock split is done based on the face value. The face value and the stock price changes in proportion to the change in face value. Rights issue is a way through which the company raises fresh capital from the existing shareholders. Subscribe to it only if you think it makes sense. Buyback signals a positive outlook of the promoters. This also conveys to the shareholders that the promoters are optimistic of the company's prospects. Open a Zerodha account. Chapter 12. Key events and their impact on markets. 12.1 Overview. For a market participant, transacting just based on company-specific information may not be sufficient. It is also important to understand the events that influence the markets. Various outside factors. Economic and/or non-economic events have a key impact on the performance of stocks and markets in general. In this chapter, we will try to understand some of these events, and also how the stock market reacts to them. 12.2 Monetary Policy. The monetary policy is a tool with which the Reserve Bank of India (RBI) controls the money supply by controlling the interest rates. They do this by tweaking the interest rates. RBI is India's central bank. World over, every country's central bank is responsible for setting the interest rates. While setting the interest rates, the RBI has to strike a balance between growth and inflation. In a nutshell, if the interest rates are high, that means the borrowing rates are high, particularly for corporations. If corporate can't borrow easily, they cannot grow. If corporations don't grow, the economy slows down. On the other hand, when the interest rates are low, borrowing becomes easier. This translates to more money in the hands of the corporations and consumers. With more money, there is increased spending, which means the sellers tend to increase prices, leading to inflation. In order to strike a balance, the RBI has to consider all the factors and should carefully set a few key rates. Any imbalance in these rates can lead to an economic chaos. The key RBI rates that you need to track are as follows. Repo rate. Whenever banks want to borrow money, they can borrow from the RBI. The rate at which RBI lends money to other banks is called the repo rate. If repo rate is high, that means the cost of borrowing is high, leading to a slow growth in the economy. Currently, the repo rate in India is 8%. Markets don't like the RBI increasing the repo rates. Reverse repo rate. Reverse repo rate is the rate at which RBI borrows money from banks. When banks lend money to RBI, they are certain that RBI will not default, and hence they are happier to lend their money to RBI as opposed to a corporate. However, when banks choose to lend money to the RBI instead of the corporate entity, the supply of money in the banking system reduces. An increase in reverse repo rate is not great for the economy as it tightens the supply of money. The reverse repo rate is currently at 7%. Cash reserve ratio, CRR. Every bank is mandatorily required to maintain funds with RBI. The amount that they maintain is dependent on the CRR. If CRR increases, then more money is removed from the system, which is again not good for the economy. The RBI meets every 2 months to review the rates. This is a key event that the market watches out for. The first to react to rate decisions would be interest rate-sensitive stocks across various sectors, such as banks, automobile, housing finance, real estate, metals, etc. 12.3 Inflation. Inflation is a sustained increase in the general prices of goods and services. Increasing inflation erodes the purchasing power of money. All things being equal, if the cost of 1 kg of onion has increased from 15 rupees to 20 rupees, then this price increase is attributed to inflation. Inflation is inevitable, but a high inflation rate is not desirable as it could lead to economic uneasiness. A high level of inflation tends to send a bad signal to markets. Governments work towards cutting down the inflation to a manageable level. Inflation is generally measured using an index. If the index is going up by certain percentage points, then it indicates rising inflation. Likewise, index falling indicates inflation cooling off. There are two types of inflation indices: wholesale price index (WPI) and consumer price index (CPI). Wholesale price index (WPI). The WPI indicates the movement in prices at the wholesale level. It captures the price increase or decrease when they are sold between organizations as opposed to actual consumers. WPI is an easy and convenient method to calculate inflation. However, the inflation measured here is at an institutional level and does not necessarily capture the inflation experienced by the consumer. As I write this, the WPI inflation for the month of May 2014 stands at 6.01%. Consumer Price Index (CPI). The CPI, on the other hand, captures the effect of the change in prices at a retail level. As a consumer, CPI inflation is what really matters. The calculation of CPI is quite detailed as it involves classifying consumption into various categories and subcategories across urban and rural regions. Each of these categories is made into an index. This means the final CPI index is a composition of several internal indices. The computation of CPI is quite rigorous and detailed. It is one of the most critical metrics for studying the economy. A national statistical agency called the Ministry of Statistics and Program Implementation (MOSPI) publishes the CPI numbers around the second week of every month. The CPI stands at 8.28% for the month of May 2014. Here is a chart for the inflation for the last 1 year in India. As you can notice, the CPI inflation has kind of cooled off from the peak of 11.16% in November 2013. The RBI's challenge is to strike a balance between inflation and interest rates. Usually a low interest rate tends to increase the inflation and a high interest rate tends to arrest the inflation. 12.4 Index of Industrial Production (IIP). The Index of Industrial Production (IIP) is a short-term indicator of how the industrial sector in the country is progressing. The data is released every month, along with inflation data, by Ministry of Statistics and Program Implementation (MOSPI). As the name suggests, the IIP measures the production in the Indian industrial sectors, keeping a fixed reference point. As of today, India uses the reference point of 2004-05. The reference point is also called the base year. Roughly about 15 different industries submit their production data to the ministry, which collates the data and releases it as an index number. If the IIP is increasing, it indicates a vibrant industrial environment as the production is going up, and hence a positive sign for the economy and markets. A decreasing IIP indicates a sluggish production environment, hence a negative sign for the economy and markets. To sum up, An upswing in the industrial production is good for the economy and a downswing rings an alarm, as India is getting more industrialized. The relative importance of the index of industrial production is increasing. A lower IIP number puts pressure on the RBI to lower the interest rates. The following graph shows the change in IIP in percentage terms for the last 1 year. 12.5 Purchasing Managers Index (PMI). The Purchasing Managers Index (PMI) is an economic indicator which tries to capture the business activity across the manufacturing and service sectors in the country. This is a survey-based indicator where the respondents, usually the purchasing managers, indicate their change in business perception with respect to the previous month. A separate survey is conducted for the service and the manufacturing sectors. The data from the survey is consolidated onto a single index. Typical areas covered in the survey include factors such as new orders, output, business expectations, and employment, amongst others. The PMI number usually oscillates around 50. A reading above 50 indicates expansion and below 50 indicates a contraction in the economy. And a reading at 50 indicates no change in the economy. 12.6 Budget. The budget is an event during which the Ministry of Finance discusses the country's finance in detail. The finance minister, on behalf of the ministry, makes a budget presentation to the entire country. During the budget, major policy announcements and economic reforms are announced which has an impact on various industries across the markets. Therefore, the budget plays a very important role in the economy. To illustrate this further, one of the expectations for the budget, July 2014, was to increase the duties on cigarette. As expected, during the budget, the finance minister raised the duties on cigarette, and hence the prices of cigarettes were also increased. An increased cigarette price has a few implications. Increased cigarette prices discourage smokers from buying cigarettes. Needless to say, this is debatable, and hence the profitability of the cigarette manufacturing companies such as ITC decreases. If the profitability decreases, then investors may want to sell shares of ITC. If market participants start selling ITC, then the markets will come down because ITC is an index heavyweight. In fact, as a reaction to the budget announcement, ITC traded 3.5% lower for this precise reason. Budget is an annual event and it is announced during the last week of February. However, under certain special circumstances such as a new government formation, the budget announcement could be delayed. 12.7 Corporate Earnings Announcement. This is perhaps one of the important events to which the stocks react. The listed companies trading on stock exchange are required to declare their earning numbers once in every quarter, also called the quarterly earning numbers. During an earnings announcement, the corporate gives out details on various operational activities, including how much revenue the company has generated, how has the company managed its expense, how much money the company paid in terms of taxes and interest charges, what is the profitability during the quarter. Besides, some companies give an overview of what they expect from the upcoming quarters. This forecast is called the corporate guidance. Invariably, every quarter, the first blue-chip company to make the quarterly announcement is Infosys Limited. They also give out guidance regularly. Market participants keenly follow what Infosys has to say in terms of guidance, as it has an overall impact on the markets. The table below gives you an overview of the earnings season in India. No month's quarter result announcement. The 1st of April to June, quarter 1, Q1, first week of July. The 2nd of July to September, quarter 2, Q2, first week of October. The 3rd of October to December, quarter 3, Q3, first week of Jan. the 4th of January to March quarter 4, Q4, first week of April. Every quarter when the company declares their earnings, the market participants match the earnings with their own expectation of how much the company should have earned. The market participants' expectation is called the street expectation. The stock price will react positively if the company's earnings are better than the street expectation. On a similar logic, the stock price will react negatively if the actual numbers are below the street expectation. If the street expectation and actual numbers match, more often than not the stock price tends to trade flat with a negative bias. This is mainly owing to the fact that the company could not give any positive surprises. Key takeaways from this chapter. Markets and individual stocks react to events. Market participants should equip themselves to understand and decipher these events. Monetary policy is one of the most important economic events. During the monetary policy review, actions on repo, reverse repo, CRR, etc. are initiated. Interest rates and inflation are related. Increasing interest rates curbs inflation and vice versa. Inflation data is released every month by MOSPI. As a consumer, CPI inflation data is what you need to track. IIP measures the industrial production activity. Increase in IIP cheers the markets and lower IIP disappoints the market. PMI is a survey-based business sentiment indicator. The PMI number oscillates around the 50 mark. Above 50 is good news to markets and PMI below 50 is not. The budget is an important market event where policy announcements and reform initiatives are taken. Markets and stocks react strongly to budget announcements. Corporate earnings are reported every quarter. Stocks react mainly due to the variance in actual number versus the street's expectation. Open a ZERODHA account. Chapter 13. Getting started. Assuming you are done reading and understanding the entire 12 chapters in our very first module, Introduction to Stock Markets, you are now warmed up to dig deeper. The objective of the first module is to give you quick hands-on introduction to the stock markets. In our endeavor to introduce the stock markets to you, we have carefully selected concepts that you need to know, especially if you are absolutely new to markets. If you have many unanswered questions at this stage, it is a good sign. You will find your answers as we proceed to other modules. At this stage, it is extremely important for you to understand why we have so many different learning modules, and how these modules are interrelated. To give you a head up, here are some of the modules that we will cover in Varsity. Introduction to Stock Markets, Technical Analysis, Fundamental Analysis, Futures Trading, Option Theory, Option Strategies, Quantitative Concepts, Commodity Markets, Risk Management and Trading Philosophy, Trading Strategies and Systems, Financial Modeling for Investment Practice. 13.1 So many modules, how are they interrelated? The idea of Varsity at Zerota is to put up a repository of high-quality market-related educational content. The content will cover various aspects of fundamental analysis, technical analysis, derivatives, trading strategies, risk management, financial modeling, etc. Each main topic is categorized as a module if you are new to the markets. You could be wondering how each of these topics fit within the grand scheme of things. To help you get a perspective, allow me to pose a simple question to you. In order to be successful in the markets, what according to you is the single most important factor? Success in markets is easily defined. If you make money consistently, you are successful. And if you don't, you are not. So if you were to answer this question for me, chances are you will think about factors such as risk management, discipline, market timing, access to information, etc. as the key to be successful in markets. While one cannot deny the importance of these factors, what is even more compelling and primary is developing a point of view, POV. A point of view is an art of developing a sense of direction on a stock or the markets in general. If you think the stock is going up, your POV is bullish, hence you would be a buyer of the stock. Likewise, if you think a stock is going down, your POV is bearish, therefore you would be a seller of the stock. Having said that, how do you actually develop a point of view? How do you figure out if the stock is going up or down? To develop a point of view, one needs to develop a systematic approach to analyze the markets. There are a few methods using which you can figure out, analyze what to buy or sell. They are fundamental analysis, FA, technical analysis, TA, quantitative analysis, QA, outside views. Just to give you a preview, here is a typical illustration of a trader's thought process while developing a POV, whether to buy or sell stocks based on a particular method of analysis. FA-based POV, the quarterly numbers looks impressive. The company has reported a 25% top line and 15% bottom line growth. The company's guidance also looks positive, with all the fundamentals factors aligned. The stock looks bullish, hence the stock is a buy. TA-based POV, the MACD indicator has turned bullish along with a bullish engulfing candlestick pattern. With that study, the stock's short-term sentiment looks positive, therefore the stock is a buy. QA-based POV, with the recent up move, the stock's price to earnings, PE, touched the third standard deviation. There is only 1% chance for the PE to breach the third standard deviation. Hence it is prudent to expect a reversion to mean. Therefore the stock is a sell. Outside view, the analyst on TV is recommending a buy on the stock, therefore the stock is a buy. The POV you take should always be based on your own analysis rather than an outsider's view, as more often than not one ends up regretting taking an action based on an outside view. So after developing a POV, what does one generally do? Does he straight away go and trade the point of view? Here is where the complexity of markets starts to kick in. If the POV is bullish, you can choose to do one of the following. Buy the stock in the spot market. Buy the stock in the derivatives markets. Within derivatives, you can choose to buy the futures, or choose to trade via the option market. Within the option market, there are call options and put options. You can also do a combination of call and put options to create a synthetic bullish trade. So what you choose to do after developing a POV is a totally different ballgame. Choosing the right instrument to trade which complements your POV is highly critical to profitable trading. For example, If I'm extremely bullish on a stock from 1 year perspective, then I'm better off doing a delivery trade. However, if I'm outrightly bullish on the stock from a short-term perspective, say 1 week, then I'd rather choose a futures instrument to trade. If I'm bullish with constraints attached, example, I'm expecting the markets to bounce because of a great budget announcement, but I don't want to risk much, then it would be prudent to choose an options instrument. So the message here is the market participant should develop a point of view and complement the POV with the right trading instrument. A well-researched POV combined with the right instrument to trade is a perfect recipe for market success. Also by now, hopefully you have got a sense of how all the different modules in Varsity play an important role in assimilating the market. So keeping this in background, go ahead and explore the content on Varsity at Zerota. The next 2 modules will explore concepts that will help us develop POV based on technical and fundamental analysis. After reading through these 2 modules, you will get a sense of developing a point of view on markets. The later modules, we will discuss the different trading instruments that you can choose to complement your point of view. As we progress along, we will ramp up the flow to help you start calibrating your trades with effective risk management techniques.